Medical expenses can take a serious bite out of anyone's budget, and especially those who face serious health issues. Many taxpayers want to know, are my medical expenses tax deductible? Well, fortunately, yes. If you have medical bills that are not fully covered by your health insurance, including Medicare premiums, you may be able to take a deduction. In this video, I'm going to show you which medical expenses are deductible, how to qualify for this deduction, and how to claim it. All right, so I want to begin by just giving you a general definition of those things that may be tax deductible. Okay, first off, as we look at this definition, notice medical expenses that are deductible must do something, and that is this: they must alleviate or they must prevent a physical or mental defect or illness. That's the criteria for you to know what's deductible. Now notice this: you cannot deduct expenses that simply benefit your general health, which of course would be vitamins or some vacation. Those things are not going to be deductible. So that's just a broad definition. Now let's get into kind of more of the specifics of this and look at some of the practitioners that we can use for these expenses. All right, so here is a list of practitioners, and that would be, first of all, of course, any kind of medical doctor. This would be your primary care doctor, any kind of specialist, certainly any surgeon that would take care of you, those kind of expenses. Chiropractors as well, as they do their treatments, acupuncturists, your dentist, any care that you receive from the dentist, of course, subject to being able to be deductible. Eye doctors, your optometrists, your ophthalmologist, certainly practitioners that would qualify. Physical therapist, occupational therapist would be included in this list as well. Of course, foot doctor, podiatrist, psychiatrist, psychologist, or really any other qualified practitioner, you're going to be able to collect and keep the receipts and then possibly use those as a deduction. Now let's talk specifically about these items. Now notice the key here before I get into the list. This says unreimbursed, because if your health insurance already covered it, then that's not something that you're going to be able to claim. These are things that you paid out of pocket. They're not reimbursed, not covered in any other fashion. And so those are the things that are deductible. So here we go. Let's go through the list. Certainly any kind of preventive care that you had to go through. Any surgeries. Prescription medications, glasses, contacts, dentures, all those kind of things deductible. And then hearing aids, transportation, and this means transportation to and from places where you had to have medical treatment. You just keep a log of the miles and they'll give you a deduction for that. Any kind of medical insurance premium. Now I want to clarify this one. This means this is something that was not payroll deducted. You just simply paid this out of your checking account, and so this is not pre-tax money. Those again would be able to be in the list of deductible items. And then any kind of health insurance deductible. Some plans have a $1,500 deductible or a $2,000 or $3,000 deductible. So if you paid that out of pocket because it wasn't covered by your insurance company, then certainly that is definitely deductible. Any co-pays that you have, the $5 co-pays or $50 co-pay to see a doctor or a specialist, and then co-insurance, which is a percentage of the bill, we can deduct that. And then as it specifically, we talk about Medicare. Medicare does have some premiums. Now the majority of people on Medicare do not have a Part A premium. Anyone that's paid into the Medicare tax system for at least 10 years, they call that 40 quarters worth of work, you paid in the tax system, Part A is a zero premium. But some people do have to buy Part A. This year it's anywhere from $278 a month to $505 a month. But if you're paying for Part A, then that'd be something that you could deduct. Part B, almost everyone does have a premium for this. This year it's $174.70 a month for most people. That would be a single filer below $103,000 income, married filing a joint return below $206,000. Each of you would pay $174.70 a month for your Part B premium. Comes out of your Social Security check, or they bill you for it. But the point is that would count in this list. Now, if you're high income, you're above the $103,000 as a single person, or above $206,000 as a married couple filing a joint return, then you have additional amounts, and those are called IRMAs. Okay, IRMAs. And then if you have a drug plan, which most people do, if there's a premium attached to the drug plan, again, it can be in the list of deductible items. And then also Medigap premiums. This would be Medicare supplemental policies. Most people today have either a Sup Plan F or a G or an N, but you're paying a premium to an insurance company. Again, you want to keep records on that because that most certainly is going to be a deductible item. All right, so there's your kind of a broad category of those things that we can deduct. Hey, if you found this video helpful and you want to see more Medicare information just like it, then go below, right below the video, and you can give us a thumbs up as well as subscribe to our channel. And every time I put a new video, which is about 2 every week, you'll be notified of that video, and others just like you who need this vital information will get it as well. All right, now there are also a few things that we cannot deduct, and let's look at that list just real quickly. Number one, any kind of pre-tax premium, which means you're paying a premium, you're a part of an employer group plan, either you or your spouses, and you're paying a premium. Normally that's coming out tax deductible, so it's already tax advantage, so you're not going to be able to use that as a deduction. Okay, so those health insurance premiums taken out of payroll, not deductible. Any kind of expense that you paid with an HSA, those are called health savings accounts. So this is someone that has an employer plan and they have an HSA, they're contributing to that HSA, that money goes in pre-tax. So when it comes out for medical expenses, you can't use that as a deduction. Why? Because you've already been tax advantaged on that particular money. All right, and then number three, any kind of elective cosmetic surgery, meaning not necessarily medically necessary, but you had a cosmetic surgery. Now, there are lots of cosmetic surgery that would be covered. So if someone had some kind of a congenital abnormality, some type of an injury or an accident, therefore they needed cosmetic surgery. It could be a disease or an illness that actually has resulted in some necessary cosmetic surgery. That would be deductible, just not the elective type of surgeries. And then Medicare taxes. If you're working right now, you pay into Medicare. If you're self-employed, you pay 2.90%. If you're work for someone, W-2, you pay 1.45% and they pay 1.45%. But the point is, these Medicare taxes would not be included in deductible items. And then lastly, unless the medication is approved by the FDA, you're not going to be able to deduct that as well. All right, so just a small list of things that would be off limits. All right, next let's go to what I'm calling the formula that we would use to be able to itemize our deductions. You'll see here in just a minute, we're going to talk about the itemized deduction versus the standard deduction. And so what happens if someone is going to itemize their deductions, this puts them in a wonderful position to be able to count those medical expenses. All right, so I want to make sure we're clear on how we do that. So you're going to notice here, this is using the Schedule A. It's a Schedule A where we have these itemized deductions. All right, and so I'm going to go through the whole list of them, but I want to start with the very first one on the list, which is what? Medical and dental expenses. And so what we have is we have a formula to determine how much of your total expenses can be deductible and how much would actually be exempt from any kind of deduction. So here is the formula that we're going to look at. And the first part of the formula is this. It says here, medical and dental expenses, see instructions. And this means they're saying they identified the different things that can be deducted. And again, I try to give you kind of a summary of those, but again, there's so many expenses that are in the list. And again, these are unreimbursed items. And so we're going to take the total of those items, unreimbursed, and I'm just going to use the example of $20,000. Okay, $20,000 of unreimbursed, uncovered by our health insurance medical expenses. All right, then we go to line number 2, and this line here, it says enter amount from Form 1040 SR, which is senior, line 11. Now, line 11 is the adjusted gross income, AGI. And so that's why we put down here on our formula, line 11. And what you're going to do is you're going to multiply that, line 3 it says here. So let's do this. Let's just say our AGI is, I'm going to say $70,000. Okay, and we're going to take that number and we're actually going to multiply that times 0.075. So this is times 7.5%. All right, so let's do the math on this real quickly. We have $70,000 AGI, and we're going to multiply that times 0.075 or 7.5%. And that number is, in this example, $5,250. Okay, now watch. So we took AGI of 70,000 times that, and that gave us $5,250. And what I'm trying to show you is that line right there is non-deductible amount. In other words, the only thing we can deduct would be those amounts that exceed the 7.5%. So that is not deductible. And so that's why that is called in there. Then they say on number 4, subtract line 3 from line 1. And it says if that line 3 is more than line 1, you enter a 0. So here it's clearly not. The difference is going to be what? $14,750. And so that right there is then going to be subject to deduction. And of course, we're going to look at the other items on the Schedule A, but that's a nice healthy number in this example that would allow us to actually deduct these expenses by using the itemized Schedule A versus the standard deduction. All right, so let's look at an example where we may not be able to do this. Let's just say that someone has, let's say they have $5,000 in medical expenses, right? And that's the receipts they have, unreimbursed, not covered by health insurance. And so again, we take the 0.75 times our adjusted gross income. And again, that number is going to be the same, 5,250. And there it says here, subtract line 3 from line 1. If line 3 is more than line 1, and it is in this example, then we would have to put a 0 over here, and then we wouldn't be able to deduct any expenses from a medical standpoint. Okay? All right, so that's the formula that we would follow. And so what we're saying is total expenses minus the non-deductible then gives this here. And so as long as that number is going to be higher than that which is exempt, now we have a deduction. Hey, Medicare can be very confusing. In fact, people make mistakes all the time because of how confusing it is. So what I've done is I've actually created a Medicare, notice this, Essentials Workshop, where you have the opportunity to really learn everything that you need to know about Medicare so that you can make Medicare decisions. There are thousands of people every month that watch this workshop, and we get lots of reviews saying that this is something that really was helpful to them. And so what you can do is down here below in the comments section, you'll see where it says pinned comment. At the very top of those pinned comments is a link. And you click on that link, what we're going to do is we're going to give you free access to this Medicare Essentials Workshop. And we want you to watch it because we don't want you to make any mistakes. All right, now let's look at the second part of the Schedule A, and that would be any kind of taxes that you paid. This is the next item after our medical expenses. So this is, they're saying state and local income taxes, our real estate taxes, personal property taxes, and we would take all these taxes, of course, and they would put this number right here at whatever that dollar amount would be. So we had our medical expenses first, and now we go to our taxes, part of Schedule A. Now let's look at the third part. And this is going to be interest that you paid, part of the Schedule A. Again, this is going to be our home mortgage interest and points, also deductible. And again, then we're going to put that dollar amount over in here. So we've got medical expenses, we've got our state and local taxes, real estate taxes, property taxes, personal property, and now this interest that we're paying, part of the formula. All right, then we go to just a couple more items, and you're going to notice we can now look at our gifts to charity. So these could be cash gifts or gifts that you actually wrote a check for. A limit, of course, for the cash gifts, but if we've given to charity, we're going to put that number in here, of course. And then we have casualty and theft losses. This means that there was some type of a federal disaster, and that federal disaster, claimed some property of yours, you lost property or whatever. And again, that loss then could be written here in line number 15. And then lastly, other itemized deductions. When you look on the form, there's a few other items that could be included that were not part of our main list. And again, we're going to put that in here. But here's my whole point. We're going to take all these items, medical expenses, real estate taxes, income taxes that we paid to the state, personal property taxes, gift to charity, all these items here that are going to go down here, and now we're going to have a total. And what I'm trying to teach you is this: once we have gone through the Schedule A and we've itemized our deductions, if that total amount exceeds what is the standard deduction that we'll look at next, then we're able to take advantage then of being able to claim these medical expenses. And so we know the first 7.5% of the AGI was off limits, but everything above that exceeds that 7.5%, if it went on that one line there at the very top of our Schedule A, now we can deduct those expenses. All right, I want to conclude by giving you the 2023 numbers. And of course, I'm shooting this in 2024, but I'm saying the 2023 numbers for standard deductions to make sure you're real clear on what these are going to be. So let me kind of explain the chart here. So we're talking about itemizing our deductions versus just using the standard deduction. So whatever is the greatest, that's what we're going to use. Okay? And so for the tax year 2023, what we have, notice we have two different columns. And I want you to see here, this says turning 65, notice on or before January 1, 2024. In other words, this person was already 65 and they qualified to file what's called a 1040 SR, 1040 senior. All right. Now, so that's one column we're going to look at. Then we have somebody's turned 65 on or after January 2nd. Okay, so meaning they're going to turn 65 during the year of 2024. They cannot actually claim on the 1040 senior. They're going to have to use just the regular 1040 standard form. Okay, now we have 5 different ways in which we can actually file our taxes, and so depending on how we file them will determine what our standard deduction is going to be. So let's look at those 5 filing options. So first off, if you're a single filer, the standard deduction this year, $15,700. So again, if we itemized and on that line 17 it's higher than the 15,700, then you're going to itemize instead of taking the standard deduction. Now, if you're a married person, but you and your spouse filed separate returns, you'll notice standard deduction is $15,350. A married person that, a married couple that files a joint return, you're going to notice $29,200 is the standard deduction this year. Qualified surviving spouse. Now let me explain this one. This means that during this tax year, your spouse died. So you can claim your taxes because as long as you were married to that person and did not remarry during the tax year, you qualify to be what's this particular amount. So it's qualified surviving spouse. What's also interesting about this is as long as you don't remarry and if you have dependents that you're still raising that qualify, then you actually can claim this particular status for 2 more tax years even after the year of death. All right. And then lastly, a head of household. And again, you see the deduction here, $22,650. So what's the point? If I have itemized deductions that exceed these amounts, then I'm going to use my itemized Schedule A. If not, then I'll just take the standard deduction. Now, those of you that didn't turn 65 until January 2nd or thereafter, what's going to happen is, again, we have the same filing statuses, but you're going to notice here, because it's you're younger, you don't have the benefit of that additional amount being a senior. Okay, so this is someone that's not yet eligible to file the 1040 SR. And so single, $13,850. Again, married filing a separate return, $13,850. Again, a married filing a joint return, $27,700. A qualified surviving spouse, you can see a little bit less as well. All these are about $1,500 or less of a deduction, and then a head of a household. All right, so we take the time to keep all of our receipts for those unreimbursed medical expenses, and then we take all of our other deductions, the home interest, the taxes, and charitable giving, all those kinds of things. And so we, again, if that number exceeds these, then you're going to be able to use your medical expenses as a tax deduction.